Hey, welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our terrific podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Thursday, September 12th. And joining me, as always, remote from a very posh hotel in Scottsdale, Arizona, it's the ubiquitous Dr. Orphe Divounguy, PhD economist, and all-around good guy. Hey, Dr. O, every Monday at thecentersquare.com, you write the Everyday Economics column, which offers a look at the week ahead in economic news. And you and I check in with the economic calendar to see what's coming up. And today's the day for us to do that. I'm looking ahead at what's coming up, and we've got some interesting things. U.S. retail sales are going to come out. We're also going to get housing starts on Wednesday. So retail sales come out on Monday. Housing starts come out on Wednesday. We're going to get initial jobless claims. And everybody's paying attention to the jobs numbers now because of the significant recalculation of jobs. We're going to get existing home sales coming out on Thursday as well. And then Friday, all of the big wigs in economics apparently are taking the day off. There's not a single thing on the economic calendar. So what are you paying attention to?
I think you missed the most important.
What did I miss?
The FOMC interest rate decision.
My bad.
The Fed Chair's conference is probably the one and only thing people will be really paying attention to this week.
I wasn't paying attention to it at all. I mean, they gotta get off this. They got to get off these acronyms, man. I mean,
yeah. Let me tell you something. The Fed decision day is the most important day.
That has sneaked up on me, to be honest with you. I know we've been talking about it for two weeks, saying it was coming in 2 weeks, and lo and behold, that's Wednesday, September 18th.
That's right. So why don't we recap a little bit what happened? So we had a couple of jobs report that showed basically employment growth was slowing.
Yes.
We had the revisions, the data revisions, downward revisions, right? That kind of put some fear or concern into market.
Well, it was wildly off. I mean, you're talking about 800,000 plus jobs off.
Totally. And then you also had the revisions in June and July, right?
Yeah, right.
That were included in the August report. And so we're learning that the labor market had actually slowed a lot more than previously thought.
Yes.
And that basically, right, we know. I think we know that the economy is just is really a combination of productivity growth and employment growth. And if employment growth slows, you really need productivity to take up in order to keep growing as an economy. And so, the good news, of course, is that productivity growth is higher than it's been in a long time. The other good news is the share of prime age Americans in a job is the highest it's been in 23 years. The other good news is, of course, the unemployment rate remains at 4.2%, which is still historically low. And of course, today we got some unemployment claims data that shows basically unemployment claims remain very low, stable. So the labor market might be slowing, but it's still looking pretty good on the level, and the economy is also looking pretty good. Now we got some CPI data this week. CPI advanced 0.2% as expected. But core inflation, core CPI actually advanced 0.3% higher than last month, 0.2%, but also higher than the consensus forecast.
So let's pause there and let's break that down and make sense of it. So why do we care? I mean,
we care because if price disinflation isn't occurring very rapidly, then perhaps the economy is not as slowing as fast as people thought it was. And perhaps the concerns, the fear about looming recessions may be exaggerated, right? And so And so that data kind of helped the yields recover a little bit, right? They dropped initially, but now they're climbing again. Uh, and so that's kind of what's going on, right? The PPI data earlier today, came in exactly as expected. Yeah, so there were some recession fears, offset by the fact that core inflation seems pretty stable where it's at. And so, we go into next week with markets looking at the Fed and
Right.
wondering what the heck the Fed is going to do.
Well, let's zero in on that. Okay.
Yeah.
So, I mean, we have gone now, is it 10 months since there's been an adjustment to rates? Have we been static for 10 months now?
It's probably been that long. Yeah.
Okay.
I mean, it feels longer.
So
For sure.
this year, to reset it for people who, maybe haven't been following along, and heck, I didn't even realize that Jay Powell was going to be speaking this week. Forgive me for that. But there has been chatter about the number of cuts that are coming this year, and some of the forecasts or prognostication on the number of cuts that would have occurred in 2024. Of course, many people thought they were going to be happening a lot sooner. Still may come. So the big question right now in this moment would be, what's the size of this cut going to be?
Yeah, look, I think markets expect 25 basis points at the next meeting. But then when you look forward, you see that they expect 50 basis points at the next meeting after that. And then another 25 basis points. Altogether, they expect the Fed funds rate to drop by 100 basis points before 2025, before the start of next year.
And for in layman's terms, 1%.
Yeah, exactly. And 1 percentage point, right? And essentially, when you look at where core PCE inflation is today, it's at about 2.6%. It's 2.6% higher than a year ago. Then that kind of coincides with the March Fed projections. And in those same projections, the Fed expected to have the Fed funds rate decline by about 75 basis points by the end of this year.
Yeah.
And so markets are still expecting a little bit more than I think the Fed is prepared to do before the end of the year. And then with the latest jobs report that we got last week, the market kind of got ahead of itself again. Now expecting the Fed funds rate to fall to the 2.75 to 3% range by next year. Down further from the previous expectation of about of the Fed funds rate settling in a 3.25 to 3.50 range, right? And so the market is expecting even more, a deeper rate cut into next year than I think is warranted given the economic data that we have today.
Well, I appreciate your thoughts as always.
And of course, I have to add.
Please.
The implications for that is that perhaps the 10-year yields might actually start increasing again from where they are, right? So yields reflect Fed expectations. And if those expectations keep shifting down, but the Fed doesn't deliver, then yields could come back up.
Mm-hmm. Good insight. I appreciate you adding that. We're going to call it good right there. Make sure you check out Dr. Orphe Divounguy's column every Monday at thecentersquare.com. For Orphe, this has been Chris Krug. Subscribe to Everyday Economics and dozens of high-quality podcasts at americastalking.com.